Let me now bring on board Prabhat Avasthi, Managing Director and Head of Equities with Nomura India. Prabhat, good morning. Thank you for joining us. Prabhat, characterize the current market environment for us. For the quarter gone by, which is Q4, Indian markets were up by about 13%. What is your opinion when it comes to the current quarter?
We are a bit more circumspect going into, at least in the near term. And clearly we've had a strong rally compared to the global markets. We were sort of outperformed compared to the regional markets because we essentially were sold down much more. So that normalization happened. I think over the next 3 months it'll probably be sideways to down is what we sort of think. That there is a risk the markets will increase essentially.
What do you think is the trigger that could snap us out of this range-bound downward bias move?
Well, I think for a clear direction upwards, I think we need a fair amount of action on policy front. And what I mean by policy essentially is not only the general policy, but also the fact that markets need to see clear evidence of fiscal consolidation. While the fiscal consolidation has been promised in the budget, action on things like containing subsidies will go a long way in getting markets up the curve. Because in absence of that, essentially all your rate cut theories, etc., will start to crumble. So essentially what we need is largely policy action.
Prabhat, exactly a week ago when I interacted with you on different forum, you were of the view that it is time to buy banks. So on this forum, let me ask you, why do you think it is time to buy banks?
No, I think you. What I said is that banks over a 12-month period are still decent bets. In the very near term, I think you'll get an opportunity in the next 3 months to buy banks probably cheaper. Now, why I'm saying banks? Because ultimately the long-range, trajectory of rates is still down. While the next 3 months might still be turmoil, have more turmoil. But the fact is that if you are playing a slowing economy along with a rate cycle on a downward bias, then you don't want to buy growth, but you want to buy pure rate cyclicals. And banks tend to fall in that. They have so the fact is that over a longer horizon, we still think that banks are the best bets to play the interest rate cycle. But the time will probably be over the next 3 months.
Prabhat, we've got the earnings as well slated. This week itself, you've got Infosys, which is going to come out with its fourth quarter numbers. Which sectors do you think will post good numbers, and where are the expectations lowest?
Our report is not out yet. I can make a general comment about earnings, and I guess is that the earnings season will not be as bad in this quarter, and there are several reasons for that. One, there are no major headwinds for corporate earnings in the quarter gone by. There was some amount of recovery in demand, aggregates, things like steel demand, cement demand, etc. were pretty strong. There were no major headwinds from increasing raw material prices. Interest rates were stable. They're still not rising. So from the perspective of corporate earnings, I think quarter was okay. It was not a bad quarter. So earnings actually on an aggregate basis might actually be pretty decent. Having said that, the fact is that we have actually moved into a sort of slower trajectory of earnings, given that the growth has slowed down. But particular reference to this quarter will be better than what we have seen in last 2-3 quarters.
Prabhat, so at Nomura, what exactly are you advising your clients? Are you advising your clients that they should expose themselves to global businesses because global economic growth is back? Or are you advising your clients that they should expect themselves to domestic businesses because Indian consumption in the near term is unlikely to slow down?
We are actually advising clients to increase their overweight positions on essentially export sectors. Now, what we basically sort of are concerned about is rupee depreciation in the short term, primarily led by India's external account position, and that essentially means that the domestic businesses might actually not outperform some of these export-led businesses. So we're essentially advising buying IT and pharmaceuticals as a hedge against rupee depreciation. So that is the main advice. And within consumer, frankly, I would say that consumer, we think this secular story of consumer might not be as strong in the coming quarters and months, primarily because of the fact that ultimately any fiscal rebalancing will have to be led by a burden on consumers. So we are seeing power tariffs go up. We'll probably see, fuel prices go up. So the consumer will probably be burdened more. And that run that you've seen of consumer, which has been extraordinary compared to the rest of the sector and economy, will probably start to taper off. So really speaking, if the market needs to go up and has to go up, then it'll have to be on the back of old economy sectors like banks and real estate and maybe with the lag ultimately capital goods. So you cannot continue to have consumer outperformance continuing without economy getting seriously disbalanced, which ultimately will lead to the underperformance of all stocks. So our guess is that you're in that phase where consumers starts to pay back what they have been given. So we are actually underweight consumers over a 1 year period.
So what explains the underlying price trend in HUL, ITC, Titan? Some of these stocks are at a 52-week high, all-time high, and irrespective of the macro or the micro, they're refusing to come down.
That is primarily because of the fact that these are there are two factors. One, as I said, consumer has been the big beneficiary of all government policies. And that has reflected in, accelerated growth in these companies over the last 5 years, basically post-crisis in 2008. So we have had a 4-year great run because consumers has got the bulk of government fiscal expansion has essentially accrued to the consumer. That is point number one. Point number two is that given the uncertainty in macro environment, given higher interest rates, you have gravitated towards companies which generate high cash flow because they are less leveraged because they essentially are mostly unaffected by the rate policy. So both the underlying growth because of policy push and the fact that the rest of the sectors were unattractive and therefore crowding in has happened in these sectors over the last 2-3 years has resulted in multiples going up. And therein lies the danger because your multiples are at a massive stretch compared to the long-range averages. The premiums to market are very, very high. And therefore, even if these stocks don't fall, if the market has to go up, then the underperformance of these stocks has to come through over the next 2-3 years.
Prabhat, what's your view on FMCG? Large funds like GIC as well are finding these pockets pretty attractive. You've got pricing power as well, which seems to be now coming back to these players.
Well, the whole point again, I've been saying the same thing again and again. Basically, the point is FMCG is a consumer expression. The pricing power has been on account of the fact that consumer has, there has been, enormous amount of income push in the system, and that's why there has been price inelasticity. But I think, as I said, sometime in going forward, there will be a slowdown, which will be compared to the rest of the sectors. And that basically means that there will be some. Now, let's not take away these long-term secular growth stories. There will be companies in FMCG which are underpenetrated, which are stock picks, but sector as a whole, so that there are 2 points. One is earnings growth, which might still be 15%, 10-15%, and there will be a multiple expansion. I don't think we are in for a multiple expansion from here in this sector. So with respect to the market, I think it's a very tough sell to sort of continue to say that FMCG will continue to outperform over a 2-3 year period even from here, when the consumer is not going to get anything additional from the government. In fact, quite the opposite.
Prabhat, in last 1 week, money managers have got not one but two reminders that European problems are far from over. First, comments from the ECB president, Mario Draghi, and then Spanish bond auction which backfired on Thursday. Do you think the LTRO2 effect is now fading away?
Well, not really. The point is that there has been some amount of risk flare, but if you look at the spreads, CDS spreads, etc., they're still pretty manageable. But I would agree with you that there will be a repeat of the worries on Eurozone time and again. And also the fact that, so to some extent you are right in saying that the LTRO effect probably is starting to wane. And that's probably one of the reasons why we are very circumspect on India, because the current account balance is so poor that any risk flare can be fairly tough for our markets, and therefore in the short term we sort of are pretty circumspect on how the Indian markets will behave.
So are you advising your clients to sell equities or to short equities? Well,
but what we're saying is that the markets have a downside bias in the short term, that the rupee could be a big risk factor, and therefore you should buy insurance against that. I think the fact is that this is portfolio advice. This is not absolute advice. Absolute advice is colored by the fact that, or it gets more difficult by the fact that the global liquidity conditions can still continue to get flows into the market, as we have seen, despite whatever fundamentals we have seen, a wash of liquidity into the markets, and that has kept the market going, pretty stable and also refusing to give up even after disappointments and things like budgets, etc. So what we are saying is, you realign your portfolio towards technology and pharmaceuticals, reduce some of the domestic beta, and then wait for better entry points.
What do you like within IT? What do you like within domestic pharma? Because IT, there are 30 listed companies. Pharma, there are about 100 listed companies.
And I won't go into stock specific, Nikunj, but we basically are saying that you buy large caps, and in pharmaceuticals, again, this is probably a bias is more towards mid caps, which are cheaper compared to. But the fact is that it is not a stock specific advice. It is more an advice based on certain macro conditions that we think are a risk for the market. Most notably, the external, account position of Indian economy.
About one final question on asset allocation. Indian equities are already up about 12-13% this year. Fixed deposits are promising to give you a risk-free 9% return, and fixed maturity products will give you 10% return. Is a medium-term investor better off investing in alternates, and time to invest in equities will come, but according to you, it will come only after 3 months?
Then I think if you ask different people this question, the answer will be different. It depends entirely on a risk appetite. I don't think there is one issue fits all question that you can ask in this regard. I mean, if you're looking at whether returns risk, so the question to ask actually is, given a particular fixed risk appetite, does it I would think that fixed income instruments on a risk adjusted basis will probably give you a better return from here or next 12 months. But the question is whether you have higher risk appetite or not, because then you should be able to take the downside. From here, I would say that fixed income probably is better over 12 months, unless the equities market conditions and macro conditions improve, and that I think is still sort of hanging fire as far as overall environment is concerned.